Look, I would say the market continues to be very strong, very resilient. It's clearly found its place as probably the number one tool for sponsors to finance buyouts, in particular in the core mid-market kind of space. In terms of what is sort of generally working, there's obviously certain sectors that people really like. Certain parts of the TMT software space, financial services, education, B2B services, that I think generally work quite well for the asset class. In terms of concerns, look, there's obviously a lot of press around the industry at the moment. What that sort of means for LP sentiment, LP appetite. And clearly, I would say the number one fear for everybody at the moment is how software buyouts in particular will develop in the months or years to come. For us at Macquarie, our investor base generally skews, I would say, fairly strongly towards Asia, towards Australia. And what we have observed there is a little bit subtle, but a little bit of a shift, probably slightly away, I would say, from US direct lending, which would have been a core allocation for many of our LPs. A little bit more towards Europe as people are seeking to diversify both currency and to some extent geopolitical risk. And then I think sort of the other trend we've sort of clearly observed is probably stronger appetite more from the insurance sort of space as opposed to perhaps traditional institutional sort of capital. But overall, I would say appetite remains strong, and this continues to be a core allocation for people in their respective portfolios. I'd say in general, credit, unlike equity, really all or most of the alpha, at least in my opinion, is generated from avoiding losses and really that in investment discipline and really preserving capital above sort of all else. And so I think where alignment really works and how we sort of do it is that the GP invests alongside the LP in the actual kind of underlying transactions, so that there's not just benefits on the upside, but also that there is, some shared pain sort of on the downside. And that we found resonates really well with the investor community, in particular in more turbulent times such as these. We've definitely seen, look, it's an increasingly competitive market, and we've definitely seen pressure on pricing, but I would say also overall terms, in particular sort of some of the other parts that form part of credit documentation versus maybe 24 sort of months ago. I think though, the market is big enough now that there's sort of something for everybody. And as long as you as the GP don't have immediate and urgent deployment pressure, we've largely seen people make, rational decisions around risk return. But clearly, we've been doing this for 17 years. It's very different now than it was 17 years ago. I think the change in the software space, is not really new. You had people moving from very back in the old days from mainframe to desktop, from desktop to mobile. We had on-premise going to SaaS. So this is a very, very dynamic industry, and business models change quite a lot over the course of 5 to 10 years. So that I think always has been part and parcel of what's been happening here. Clearly, AI, I think some people are calling it the second industrial revolution, might sort of speed this up. But I think people have generally picked hopefully the right assets, vertical versus horizontal, probably at least for us a strong bias towards regulated industries versus not, people where you are the sort of system of record, etc. And, also let's not forget that in a lot of these, in particular in software buyouts, there is a very, very substantial amount of equity behind, 50% plus kind of equity cushions. So it's a key focus for us. I think it's a key focus for investors. It's your question is the number one question that LPs ask us about this space. But we are, I would say, cautiously optimistic that we and the rest of the market have picked the right assets.